Are you still stuck on the SCHD being the best dividend ETF out there? Or are a lot of smarter investors rotating into the DGRO or the VTV for better returns, better diversification, and a stronger dividend growth with the portfolio? Today, we're going to break down each one of these ETFs and actually showing you which one wins in 2025 and which one you can kind of rotate in, knowing there could be a pullback from AI. Hello, guys. Dennis here, helping to build your wealth through consistent, disciplined, long-term strategies investing. Today, we're going to break down one of the biggest debates that I've been getting and a question that I get almost every single day when it comes to the SCHD from the dividend community. Is the SCHD still the absolute dividend king that it was, or are funds like DGRO or VTV beginning to really outperform it? And I do want to do a side-by-side comparison. So by the end of this video, you'll know the major differences between these three ETFs, what investors are shifting to, and what I did instead of an alternative to the SCHD. And is this ETF really the fit for your long-term strategy? So let's go ahead and break this down. Now, before we get into the comparison, let's look at the SCHD. This is a quality-driven dividend ETF focusing on companies, and it has a very strict rule guidance that it goes by. 10 plus years of dividend payments, weighted by high return on equity, very strong cash flow from these companies, consistent dividend growth. Now, expense ratio 0.06, so incredibly low. Dividend yield between 3.5 and 4%. And also note that this does do a reconstitution every March. It rebalances into making sure, again, that it is kind of falling in those guidelines that they have set with the SCHD. Now, over the past 3 years, unfortunately, it has kind of underperformed because AI has been so dominant, and this is not a strong contender when it comes to tech stocks. Now, investors absolutely love the SCHD, and a lot of you guys probably still hold it. Very reliable. It is focused on quality of the companies itself, and historically outperforms a lot of dividend funds. Now, the bad side, and this is where it gets a little frustrating with the limitations, very heavy in industrials, finances, and energy, very light on tech. When we have a strong bull market like we're seeing right now with artificial intelligence, it really does underperform, and it underperforms very, very consistently. Missing large parts of the market doesn't mean it's strictly dividend screens, and I think they might need to look at some of the rules that the SCHD has been really running by. This leads to many long-term investors to consider other things like the DGRO or the VTV as diversification, or even replacements in the entirety when it comes to that SCHD. So the DGRO, what exactly is this one? We are looking at the iShares Core Dividend Growth ETF, one of the strongest, if not the strongest competitor when it comes to that SCHD. So what exactly makes it stand out? Now, this emphasizes on growth. Companies with 5 years plus of rising dividends. So it might not be that 10-year consistent payout, but 5 years consistently of increasing dividends, sustainable payout ratios, and of course, strong cash flow metrics, very similar to what we see with the SCHD, where the SCHD really prioritizes the quality of the company. The DGRO really focuses and emphasizes the consistent growth of those companies. Now, the big advantage with this one is more exposure to technology, more exposure to healthcare, more exposure to communication services, meaning the SCHD simply misses some of these companies due to the very, very strict screening process that the SCHD does possess. Now, the DGRO captures a much bigger portion of the US market, which again, we'll look at in just a minute in the side-by-side comparison, than that SCHD does. Now, of course, typical yield on the DGRO is around 2.2, 2.7%, so definitely a little bit lower than the SCHD, but it does provide a lot stronger total return when we look at the growth of this and the companies it's holding. Better long-term dividend growth is what we've been seeing, and a more balanced portfolio. So it's a little bit less about the income that it's generating today and more about the growth of income that you're going to see over an extended amount of time. Now, very similar to the SCHD, extremely low expense ratio, a 0.08. Now, the DGRO is best for young investors that are looking for long-term compounding. Anyone who wants and has to have a little bit more of the tech exposure, investors that want steadier dividend growth than we're seeing, and anyone who thinks the SCHD is over-concentrated. Then we kind of flip the script and we look at the VTV. This is the third option. This is the Vanguard Value ETF. It is one of the largest, most diversified value funds that is in the world, guys. This has a lot of money in this one. VTV includes large cap mature companies that we're looking at, undervalued mega caps, and a low P&E ratio, looking at these high cash flow businesses. Not really so much focused on the dividend and the dividend growth, but it is on the flip side looking at the value. So many of the companies within this ETF itself do pay dividends, which gives it a very nice blend because it has lower valuations, very reliable cash flow, and a stronger term upside and more tech than the SCHD. And that again is what I feel like the SCHD is kind of holding. SCHD barely holds any tech at all. I believe it's right around 10%. VTV absolutely does when those companies fall into the value territory. So if the companies are really overvalued, it does include a couple: Apple, Microsoft, Meta, Alphabet. You'll notice some of the big names out of there are absolutely missing because it feels those are overvalued, like Nvidia, and not worth investing in within this portfolio. The VTV gives a stronger performance when value and tech both rally. Now, of course, with this one, like we've seen, super low expense ratio, 0.04, cheaper than both the SCHD or the DGRO in the entirety. So who is the VTV best for? Investors who want the broad value, not just the dividends overall, investors who want a higher potential upside than we're seeing with the SCHD, younger, longer term investors, and anyone who does want to have some exposure to those mega cap diversification and those bigger companies in the entirety. So let me hop over, guys, and I want to kind of show you what we're breaking down when it comes to these two itself. Now, here is ETF.com. This is going to break down the comparison with the SCHD, the DGRO, and the VTV. I did drop my camera out so you can get and see these in the entirety. And if you're unfamiliar with ETF.com, it is an absolute perfect place to compare multiple ETFs. Now, looking in here, looking at the last trade and looking at the AUM, you can see all of these are $1 billion or really tens of billions of dollars or hundreds of billions of dollars of valuation in here. Underlying index for the SCHD is the Dow Jones US Dividend 100. And you're going to have to note the dividends in here, or the holdings in here, are 101 companies. So it does have a pretty strong concentration with the SCHD. The DGRO is running about 400 companies in here. So you are running 4x the companies that we have in the SCHD. The VTV is 316. And again, these are passive funds that are going to adjust depending on the parameters that they have set and also the underlying index exactly that they're following. So looking at the performance, this is where it gets interesting because again, we have seen the SCHD actually underperform for a significant amount of time. And even looking back here in like April of 2025, we know this was a big pullback when Trump introduced all the tariffs, everything else. And you can see the SCHD even pulled back further than the DGRO, even further than the VTV. So overall, you can see a little bit more stability out of the companies itself. And then we fast forward to the most recent. SCHD is performing at a negative 7.22. Now, of course, this is not the total return, but the DGRO is 6.23, the VTV 3.42. So when we start adding in that total return, again, SCHD is running about 4%. It is still coming in negative with a total return. The DGRO, the VTV return about 2.5. I think it's 2.5, 2.7. So even thinking of the 6 going to, 8 or 9, and then of course the 3 going to 5 or 6. So both of these ETFs are outperforming. Then we pan out and look at what it looks like over an extended amount of time. So even year to date on the SCHD, we are at 2%. 1 year, we're at negative 4%. And again, thinking about the 3, almost 4%, I think 3.9. I think it might have been 3.9, but right around 4%. So, okay, in the last 12 months, the SCHD with the dividend yield has broken even about 0%. The DGRO at an 8.25. Again, you put in the dividends or the compounding effect, we're well over 10%. And then we're looking at 7, about 8% for the VTV. And then we even start looking back further, guys. If you have held the SCHD like I did, 3 years is at 5%, 5 years is at 9%. And even looking over here, guys, we're at 12% here, 12.68. So the VTV or the value outperforming in the 5 years. And again, when you start adding in the dividend yield and the compounding over that amount of time, the SCHD does kind of underperform. And that's what we've seen, especially when it comes to the last 3 years. Again, because there was such a very, very high run with tech, with AI, with everything. In the 3 year, I mean, 5% to 12% and 11.31. It is a very, very different structure when it comes to the SCHD. And that's why, me personally, I've dropped out of that SCHD, putting a little bit more into the DGRO and the VTV, looking to find a little bit more value than just looking at the dividend equity. Now, again, expense ratio, very close between all of those. And honestly, anything below about a 0.3, a 0.5, not really too worried about the expense ratio. Want to worry about a little bit more of the diversification that we're seeing. Now, top holdings, this is where it gets interesting, because if you look, and again, we'll break down the sectors in just a minute, but you can see these companies are held in a pretty high standard. I mean, 5% here, almost 5%. 4.7 with Merrick, Cisco, Abrieve, Coca-Cola, Pepsi in here, Lockheed Martin. So we have, remember, SCHD, 100 companies, a lot more concentration towards those larger companies, as we can see right here. Even if they are not the biggest dividend producer, the average does come in roughly about 4%. Now, like we had said, when it comes to the DGRO, you can see Apple in there, JP Morgan Chase. So getting some of those really big financial companies in there. We have Coca-Cola in here, Procter & Gamble, Broadcom. So you can see where the exposure of tech is coming in here. And then, of course, the VTV, but you'll notice, even with this one, guys, JP Morgan, Berkshire Hathaway in there, Walmart, Home Depot, Bank of America. And overall, you can see the percentages because they hold such a incredible amount of companies, 300 plus, and the DGRO is almost at 400. They do have a much lower percentage than what we're seeing with the concentration of the SCHD. So it is yielding you and giving you a little bit more of a diversification within a single ETF itself. Then we start looking at the sectors. This is very interesting because when we did the reconstitution, March of 2025, you can see the SCHD went very heavy into healthcare, very heavy into consumer non-durables, and energy and minerals, very heavy in all three of those. That's where a lot of people are saying when you look at the concentration of the SCHD, it really needs to look at the rules that they have behind it and the concentration that we've seen of what it rotated into. I know there were a lot of people, and a lot of people have commented that they were not too happy overall with this. Now, looking at the DGRO, you can see healthcare still pretty strong in there. Same with a couple other ones. Finance, a lot in there. Electronic technology, again, really pushing up some of these sectors. And then the VTV that is strictly looking for the value within these companies. And again, these are going to adjust based on where the value is and what companies fall within the value metrics. Healthcare, definitely a little bit low. Durables, a little bit low. Energy, minerals, electronic technology, really looking at a lot of value within finance. Then we do have a little bit into retail trade and a couple other ones. And again, looking at what we have here, healthcare technology right across the top, 15% here, 18% in SCHD, non-durables at 15.5, 9 and 7. Then you start getting into energy and minerals and looking at the concentration across these four sectors, because even here, electronic technology, 12%, that makes up a majority of the SCHD, 13.7 here, 10. Look at the finances, 9.3, 19 and 26.5 within the value. So we are finding a lot of value as it sits currently within the VTV, really doing well within there, and looking again at the performance over the last 1 year, the last 3 years, even looking at 5 years. It's very interesting to see exactly where these are kind of falling into. So guys, looking at the comparison and looking at it, it's really interesting to see, again, where a lot of people have sold out of the SCHD or even cut their stake, where I know some people were in there, 20, 30, 40% into the SCHD. Now, the big thing with that is it's going to make a really big difference when it comes to retirement, when it comes to being able to kind of supplement the income in there versus having the ability to grow for a multitude of years, which again, the SCHD could be a perfect vehicle for a lot of stability in a portfolio if you're looking to generate income. But honestly, holding it in a much larger part of a portfolio and thinking of the value section of a 3 ETF portfolio, if you're holding it roughly 40%, looking maybe 10, 20 at the most for the SCHD, putting some into the other 2 ETFs in the entirety. So if you found the video helpful, let me know about your dividend strategy, guys. Hit the like button. It helps the channel grow. Get the video out to anyone who wants to learn how to build wealth the exact right way. Let me know if you hold the SCHD, the DGRO, the VTV. They are three ETFs that are very powerful. So staying disciplined, staying invested, and staying focused is going to build that legacy. And I'll catch you in the next video.